thing that nobody in finance wants you to figure out on your own. The bank doesn't make money for you. The bank makes money off you. And the moment you understand that, really understand it, not just nod at it, your entire relationship with money changes forever. I've watched people spend 30, 40 years handing their capital to institutions, paying interest to strangers, begging loan officers for permission to use their own financial momentum, and then they retire and wonder why the math never quite worked out. I'm not here to make you feel bad about it. I'm here to show you the exact mechanisms that wealthy people, the ones who don't talk much about what they do, use to keep capital moving inside their own ecosystem, not inside a bank's ecosystem, their own. We're talking about 3 specific tools today. I'm going to explain them the way I wish someone had explained them to me, without the sales pitch, without the jargon fog, and without pretending these are magic tricks. They're not magic. They're just logic. And logic applied consistently builds extraordinary wealth over time. Stay with me for the next several minutes. What I'm about to show you is the most practical financial education most people never receive. Here's a mental model I want you to hold on to. Think of a river. Water flows in, water flows out. The bank is the dam. Every time money moves through your life, your paycheck, your mortgage, your car loan, your credit card, your business line of credit, it flows through that dam first. The bank skims the difference always. Now, here's what the wealthy figured out. What if you build your own dam? Not to stop the river, to redirect it, to let the water move, let it grow, let it compound, but have you control the infrastructure instead of a faceless institution. That's what being your own bank actually means. It's not about burying cash in your mattress. It's not about crypto, though that's a different conversation. It's about building private financial infrastructure that mimics what banks do, except the profits stay with you. There are 3 serious, legitimate, IRS-recognized ways to do this. These aren't loopholes, they're deliberate provisions written into the tax code to encourage productive capital behavior. The first tool is permanent life insurance structured for banking, not just protection. We're talking about properly designed whole life or indexed universal life policies. The foundation is IRC Section 7702, which gives these policies their favorable tax treatment. You overfund the policy, paying more premium than needed for the pure insurance cost. That excess builds cash value. The cash value grows tax-deferred and can be accessed tax-free under the right structure. The real power comes when you borrow against it. When you take a policy loan, 2 things happen at once. You receive the money tax-free, and the cash value inside the policy continues growing as if you never borrowed. You're effectively earning the policy's return on the full amount while using the borrowed capital somewhere else. That's real leverage. Example, $200K cash value growing at 6-7% inside the policy. You borrow $120K at a 4-5% policy loan rate and put it into a real estate deal returning 12%. You're earning both returns while only paying the policy loan interest. When you pass away, the death benefit pays off any outstanding loan automatically and the rest goes to your heirs tax-free. Critical setup rules. Prioritize maximum cash value and early liquidity, not maximum death benefit. Look at the illustrated surrender values in year 1-5. If you're putting in $50K and the cash value is only $35K, too much is going to commissions. Work with someone who specializes in this use case and compare multiple carriers. Done right, this becomes a quiet private banking system that lasts generations. Done wrong, it's expensive. The second tool is the often overlooked 401 loan provision. There's a huge difference between a withdrawal, which triggers taxes plus a 10% penalty, and a loan, which does not. You're simply moving money from your own account to yourself and paying it back with interest. Interest that goes back into your own retirement account. Rules. Up to $50,000 or 50% of your vested balance, whichever is less, usually 5 years to repay, and the interest rate is typically near the prime or AFR rate, currently around 4 or 5%. That interest goes to you, not a bank. This is especially powerful for self-employed people with a solo 401(ng), where contribution limits are much higher. Use it for bridge financing, real estate down payments, or high-interest debt elimination. The same capital earns market returns inside the plan while you deploy the loaned amount elsewhere, best for short to medium-term needs. Know your plan documents, especially what happens if you leave your employer before repayment. The third tool is private lending between your own entities. If you own multiple businesses or entities like LLCs or S-Corps, you can create your own private credit system. Your holding company or SAFE LLC lends to your operating company or active investment entity. The borrowing entity deducts the interest as a business expense. The lending entity earns the interest income, all inside your ecosystem. You control both sides. This also adds serious asset protection. The SAFE entity holds a secured promissory note instead of owning the risky asset directly. If the deal goes sideways, your capital sits in a creditor position with priority. To stay IRS compliant, you need a proper promissory note, interest rate at or above the applicable federal rate, actual repayments, and clean documentation. Treat it like a real loan between unrelated parties. Two more powerful tools worth knowing. If you own a home with equity, a HELOC can be excellent low-cost capital. When used for investment purposes, the interest is often deductible against investment income, which lowers your effective borrowing cost. And if you have a sizable investment portfolio of stocks, bonds, or ETFs, you can access a securities-backed line of credit. You borrow against the portfolio at favorable rates, often 50–70% of its value, without selling anything or triggering capital gains. Your investments keep compounding while you use the capital. Let me step back for a moment and talk about what's really happening when someone masters these tools. It's not about being clever. It's not about finding loopholes. It's about understanding one fundamental principle that most people spend their entire financial lives ignoring. Capital is most powerful when it is circulating, not sitting. Every dollar that sits idle in a savings account earning 0.5% while you pay 22% on a credit card is losing ground. Every dollar you surrender to a bank as unnecessary interest is a dollar that cannot compound inside your own system. Every time you go to an outside institution to borrow money you could have borrowed from yourself, you're giving away a portion of your financial future. The strategies we've covered today are all expressions of the same underlying logic. Keep the capital inside your ecosystem, control the flow, earn the spread, and eliminate unnecessary intermediaries. This is not about becoming anti-bank. Banks serve legitimate purposes, and there are situations where institutional financing is the right tool. But the choice should be yours, made with full information, not a default born of ignorance. The wealthy don't have access to different assets than you do. They have access to different knowledge about how capital actually works, about which tax codes protect their strategies, about when to borrow from themselves instead of from a stranger, and about how to make the same dollar serve multiple purposes at the same time. That knowledge is not secret. It's available to anyone willing to learn it and apply it with discipline. I would be doing you a disservice if I ended there without being direct about the risks. These tools are real. They work, but they can be misused, and misuse is expensive. Cash value life insurance is a long-term commitment. The cost structure in the early years means you need to stay in the policy for a decade or more before the math fully works in your favor. Choose policies designed for maximum early cash value accumulation. 401k loans have tax consequences if they go wrong. If you leave your job or default on the loan, the balance may be treated as a taxable distribution. Related party lending must be done by the book with proper documentation and actual payments. HELOCs use your home as collateral, so understand the risk. Securities-backed lines carry margin call risk in big market drops. These risks are manageable with proper sizing, planning, and professional guidance. Never borrow more than you can comfortably service. Never deploy capital into risks you haven't fully analyzed. There's a principle I've believed in for most of my adult life. The quality of your financial decisions over time is determined almost entirely by the quality of your understanding. Not your income, not your luck, not who you know. Most people outsource their financial understanding to institutions that profit from their ignorance. You now have the knowledge. The rest is up to you. If this changed the way you think about capital, share it with someone who needs to hear it. And if you want to go deeper on any one of these strategies, the tax specifics, the entity structures, the policy selection criteria, that's a longer conversation worth having with a qualified professional who can look at your specific situation. Because the best financial strategy in the world is only as good as the execution. Think carefully, move deliberately, and make your capital work as hard as you do.